All right, everybody, thank you for joining us today. This is advanced options, okay? This is actually a pretty easy strategy to implement, to be quite honest, but because it's a naked strategy, the way I like to set it up anyway, it carries that lot of risk where, you know, you could have unlimited risk to the upside, because when we're protecting a bond portfolio, in a sense, it's pretty difficult to actually hedge it. So if you're short a call, you can't really have that bond called away from you, especially because the way we're going to be looking at this is your entire assets, all your assets put together. That would be your 401k, that's your margin account, your IRA, things of that nature. If you have bonds in your 401k, which you very well should, and if you don't, then you need to be talking to whoever is running that thing and talk to them about risk parameters. Anyway, so what we're trying to do is we are hedging that, but in a different location, okay? So we're going to have to think about it a little bit different, because when you're doing this like a covered call, let's say, on a stock, if it goes up and through your short call, then the stock gets called away. That's not necessarily going to happen here, but we're going to kind of try and create that same scenario, but it's going to be in a different place, and it's not going to be able to be called away from you. So I want you guys to be clear of concept with that. And that's part of all of this being a little bit more difficult strategy to understand and having that risk parameter added in, okay? Like, I wouldn't consider a covered call necessarily that risky of a strategy, or even that difficult of a strategy to implement for that matter. But with this one, we have to know those nuances about, well, that bond isn't going to get called away, so I could continue to lose money on that call. All right, you're going to continue to gain money on the bonds if that were to happen, but we don't want that to happen. All right, so bond protection, it's super important, you guys. It's probably the most neglected aspect of anybody's portfolio. As a matter of fact, I was talking to one guy and he was telling me he didn't have bonds in his portfolio. And I was like, you absolutely do. You just don't look at them ever. But they're in there. And if they aren't in there, then you need to add them. And if you're not running that part of your portfolio, then you need to talk to somebody. You got to have bonds in there in any portfolio, you guys, just to be diversified. All right. All right. So I want to go over a couple things. I think if my thing wants to change, there we go. All right. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or Wall Street Journal for a commentary on everything from economic to geopolitical market analysis. I started trading in college with some money I had earned and decided, you know what? I don't want to be a psychologist. I want to be a trader. So started playing around with finance, switched my major over to finance, and then after graduating, moved up to Chicago because a buddy of mine was like, Eric, you'd be perfect on the floor of the Board of Trade. So I went and checked it out for a summer job and ended up staying for 25 years. But in that time, I basically traded everything from stocks, financial futures, commodity futures, currencies, and options, basically on all these products in just about every market condition. And I got to go over this disclaimer. Any opinions, news, research, or analysis or other commentary is not investment advice, you guys. I am here to teach you guys these strategies. It's up to you to implement it into your own portfolio, because I don't know what's in your portfolio already. You know, I mean, when I was talking to this one guy, you know, I assumed he had bonds in there, but he didn't, supposedly. That's the case. I don't know what's in your portfolio, so I can't give you a strategy or necessarily a stock, for that matter, to put in your portfolio, okay? And any bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, you can follow me on Twitter at Wolfman's blog, and you can follow Pro Trader Strategies at Pro Trader Strat. All right, and like I mentioned, this is using options to protect your bond portfolio. Now, it's not a direct hedge, okay? Like I mentioned, your bonds are going to be in one location. You're not necessarily going to be able to access all of them, especially if they're in a 401k. But what we are trying to do is knowing what's going to happen with our bonds as interest rates go up, bond prices go down, okay? and those bond prices go down faster than the interest rates go up. Okay. For one, it's a future contract, so it's projecting future interest rate increases as well. But there's another aspect to it that nobody really talks about, and it's called the arbitrage. And that arbitrage is what a trader is doing to the overall market. So as interest rates go up, bond prices go down, but they go down further because that bond trader knows that he's getting a lower coupon and there's a higher coupon out there for it. So why wouldn't I take the higher coupon? Well, because I'm getting this one at a major discount is the way the trader is looking at it. And he needs to be rewarded for that, right? Is the way he's looking at it. So when you have to sell that bond, that's a 4% bond, to go out and buy a 5% bond, you are going to take several years before you can make up that difference in the coupon payments. So what I'm trying to say here is basically on a 4% bond, if interest rates go up by basically 1% in value, or 1%, the value of that bond is going to drop by about 15 or 20%. So you're only getting an increase of 1% in your coupon. All right. So that's why it's going to take several more years to make up that loss of the 15 to 20% drop that you would have seen. Okay. So the only way to really do this is to try and lower our basis. Now, you guys that have been in this this whole options class for several months now have heard the covered call thing. And when we sell calls against a stock, what we're trying to do, if we bought that stock for $100 and we sell a call and collect $1, what we've done synthetically is lowered what we paid for that stock to $99 because we collected $1 for selling that call. That's the covered call strategy. You're lowering your basis. You're lowering what you paid for it. Well, with a bond, when we go out and buy it and these interest rates start going up and that bond goes down in value, you think about it as a teeter-totter. If it's level when you first bought it, okay, if interest rates go up, the teeter-totter starts tilting and the bond prices go down. Now, in that scenario, there wouldn't be any arbitrage because that's like a perfect correlation, right? But the bond is going to dip faster. But to give you an idea as the levers and pulleys, as interest rates go up and bonds go down, that's the idea there. Keep in mind, though, the bond is going to drop a lot further. Maybe one side of the teeter-totter is a little longer or something like that to get that more of a down slope there. So as interest rates go up, bonds go down, and you cannot make up for chasing yield or chasing coupon. All right. So what I talked about with that 15 to 20% drop in bonds, that's on the 30 year. It's about a 15% drop. Now the closer or the shorter duration treasuries are going to even be affected worse. So like if you had a 2.5 year duration and it increases by 1%, that's going to get a 2.5% drop. All right. If it's a 12 years, it's going to be about a 12% drop. 10 years is going to be about 7.8% drop. And then a 30 years is going to be somewhere around a 15, 16% drop. And this is what I'm talking about. Let's say we started out, this isn't a zero interest rate necessarily. This is an increasing interest rate market. But when we started out a couple of months ago, we were pretty close to zero. So this is a pretty good scenario. And if we had a bond portfolio of $250,000 and the interest rates go up by 1%, you would have seen a 20% drop in your bond portfolio. That's what I'm talking about. Yeah, you got an extra 1% somewhere else maybe, but you would be selling these out to try and get 1%. And how long do you think it's going to take you in coupon payments to make up that $50,000 that you just lost? 7, 8 years maybe. Now, when I'm talking about the bond prices going down, yes, if you held these bonds for 30 years, you are going to get par value back. But keep in mind, the average duration someone holds a bond is like 7 to 8 years. All right. So think about if you're rolling these bonds every 7 to 8 years, you've just gotten back the money that you lost on selling those bonds. And now you're rolling it again, and you've got another 7 years to make up for it if the interest rates continue to rise. So what we need to do is staff off this by selling calls against it. And we're going to be collecting 35 to 45 days. We're going to be getting all that premium back by continuing to go and sell these calls every month mechanically. And like I said, this bond portfolio might still be doing this over there in your 401k or something, but know that you're making up for that in your margin account. Okay. It's offsetting that, right? It's all one. All your assets are one, housed under one name, and that's you, right? So don't neglect that one that you just don't always keep an eye on. And I know bonds are boring to watch and nobody likes it. They just like to collect the coupon payment, but you need to be aware of it. And if you are in a 401k or something like that, a lot of those guys throw you into a mutual fund like Soros and Vanguard and all of that. But the problem is what these fund managers do. And I questioned a sales guy one time. He was trying to push his ETF, his bond ETF. And I asked him straight out, I was like, so how long do you hold these bonds in this ETF? And he was like, somewhere between 3 and 5 years. I go, so well, when we're in a rising interest rate environment and you're rolling those bonds all the time, aren't you getting scalped by all of the traders? You're basically buying high. You're buying these bonds high, getting the coupon payments. Yeah, that's all well and good. But then when you go to sell it, you're selling those in the hole like I just talked about. It's easy to figure out the math. And then all of a sudden you go out and buy another bond. So they are constantly churning in these funds because, for one, they make their money on the commissions, right? Off the back and forth all the time. And two, I don't think that they really are sure what the hell they're doing, to be quite honest. But these guys, if they were using options in these portfolios, they would do much better. But, again, I don't think some of these guys have been around longer than options were in existence. So they don't understand options. And this is just the funny thing there. All right, so let's go over a couple of things. When we're doing bond portfolio protection, we're going to be selling a call. I kind of mentioned that a couple of times. It's basically a covered call strategy in a sense. But we're going to be I like to do it with the naked calls, and there's several reasons why, and I'll go through them, especially when we pull up the platform. But when you take higher risk, you get the higher reward. All right, when you're doing a naked strategy, you're generally getting paid more for that naked strategy than if you had on a spread. I mean, there's just no doubt about it. When you have to go further out and buy something, that lowers what you initially were able to get, right? It's pretty simple. And when you're doing these naked calls, you have a much higher probability of success. In some regards, it's going to be like 20% higher probability of success, all right, which is huge, all right? I would take that any day, all right? So we always do this at the beginning, right? We're going to go over our keys to success, picking the right environment. Now, obviously with this, when we're doing coverage call strategies, we usually talk about we're just trying to lower our basis. Well, the right environment, we obviously would like higher volatility because what volatility does is it allows us to get further away from where the underlying is trading for that same strike, or for that same delta, I should say, not the same strike. So we'll be able to get further away. So for instance, if you were selling calls on $100 TLT, I'm rounding it off. I'm not going to nail the number on this one, but let's just think of it this way. TLT, where it's $100 and I'm selling a strike collecting about 30 cents. I'm lowering that overall basis. Now that 16 delta strike right now, if I had really high implied volatility, could be out there at like the 115 area if I had really high implied volatility. But if I had super low implied volatility, it's probably going to be closer to maybe, let's say, the 107 or something like that. So you can see when the volatility comes out, those deltas stay the same, but those deltas start getting closer and closer to where the market are because that probability they're thinking is much less. But Another thing I want you to think about with this, you don't have to have the super high implied volatility with this. Especially in a rising interest rate environment, which is what we want to do in this strategy. That's picking the right environment. Rising interest rate environment is the only time we're going to be doing this. And right now the Fed is signaling higher interest rates. So therefore, we are in the right environment for TLT, a rising interest rate environment. Okay. Obviously, we really want to be involved in this when the volatility is really high, but I'm going to try and stay mechanical with this every 40 days, rolling those calls out or selling calls against this TLT trade. Okay. And then picking the right underlying. Now, the right underlying here really kind of has to do with your portfolio. And I don't know what's in your portfolio, obviously. I don't even know how much money any of you guys have in your portfolio. But if you are going to be dealing with a bond portfolio of $100,000 or more, and that's all of your bonds put together, if you have $100,000 worth of bonds or more, you probably want to be using /ZB from the CME. One, you're going to have better commissions. Two, you're going to be able to do less contracts because that is going to be the /ZB is going to be equivalent to $100,000 worth of bonds. So you could do a 1-lot contract. So if you're doing TLT at 10 lots, you should seriously be considering looking at /ZB for that same exposure. And you're going to pay a lot less in commissions because TLT you're going to have to do 10 times, and they're going to the commissions are already higher on that ETF than with /ZB or the bond futures. Okay, so look at your portfolio, figure out how much money is in there, because if you had, let's say, 120,000 bonds in there, then I would do 1 ZB and maybe 2 TLT, because TLT is for increments of $100,000. All right. So figure it out and you can piecemeal it together. If you're under $100,000, you're just basically going to be going with TLT. Now, there are other interest rate ETFs out there. TVT is a negative double leveraged ETF. So it, in a rising interest rate market, is going to be looking like it is directly correlated because it is a negative leverage. All right. So it's not going to act like that teeter-totter. All right. It's going to be directly in line with, but at a much faster pace because it's ×2. Right. So stick with like TLT and /ZB for this type of strategy, especially if you are a newer trader or newer to even playing around with the bonds. Okay. And then picking the right duration. Because we're selling a call, we want close to at the money. Zebra boy, ZB Zebra boy. That's right. Yes, Zebra boy. If you're doing our, yes, /ZB is the bonds for the CME. Picking the right duration. We want 35 days to expiration because we want to take advantage of the theta decay we always talk about. Anytime we're selling options, we want to be in this. We want this decay happening to our options. Now, this is the at the money calls and the at the money puts decay. I am only trying to give you a representation here, you guys, of what happens to theta or what happens to your options premium due to theta decay. So the further out, you can see it does not decay very rapidly. But once we get inside this 40 to 35 days to expiration, then you see a 50% drop in those premiums. Now, that's all I'm looking for is like that 50% drop in premium. I'm not ever trying to take every last penny out of these, especially because once you start getting inside 7 days, if you are getting close to the money, what happens is that second dollar move on this underlying is going to be, the gamma is going to start affecting delta and quite dramatically. So you can really quickly see some of your profits evaporate in those last couple of days as the funny business, as I used to say on the floor, would happen closer to expiration. Everybody's trying, all the big money is trying to push the market to benefit them for settlement. Okay, so let's stay out of those games. We're the little guys that are going to just get beaten up in that. All right, picking the right strikes. Now, when we're doing a naked strategy, we're going to go to that 16 delta that we talk about, right? So if we're going to that 16 delta, that would be for the naked calls. If we are doing it as a spread, we have to go all the way into the 35 delta because we have to be able to collect enough premium. So let's pull this up real quick. So I got bonds up here. I'll just look at TLT because I'm going to explain the option pricing here for bonds. If you are not familiar with that, it can be a little intimidating. So TLT, we're going to be looking at TLT here, and I'm always trying to sell bonds right now because interest rates are going up. If we are in a rising interest rate market and the Fed is signaling they're going to continue interest rates, and if you guys watch the daily market commentaries, you know I'm saying these bonds cannot really go any higher because of the rising interest rate environment. So it's a good time to be selling against these type of bond instruments, selling calls against these type of bond instruments because we are in a rising interest rate environment. So as interest rates go up, the bonds go down, right? So we've seen that. The 16 delta is for the naked call, yes. So for TLT right now, what we would be looking at is the 16 delta. So somewhere close to the 16 delta is what I'm looking for. And I want to at least collect 30 cents. Usually around that 16 delta, that's where you're going to be able to collect somewhere about 30, 35 cents. And you can put it in there and work it, which I suggest. Don't ever hit the bid or the offer. There's somebody in there in the weeds willing to pay up a couple of pennies as free market price discovery is in full swing, right? You come in at 34 cents, that's free market price discovery. This guy comes at 31 cents, or there's some kind of spread in there that isn't being shown up in here, okay? That's another nuance there. If somebody has a spread in here, it doesn't always show up on the leg that it can be legged there because there's different exchanges and all kinds of things, okay? So there could be better pricing in between here that you don't see. Now, when we were talking about if we have to do it as a spread, if you guys are more comfortable with spreads, let me tell you, this is what I'm talking about. Because if you're doing a spread, you need to collect some kind of premium. And my rule is collecting on a spread a third the width of the strike. So somewhere around 33 cents. The least I'll take is a quarter. So somewhere between 25 and 33. 33 is the sweet spot. All right. But you can see I am selling this at a 36 delta, which means there's a 36% probability that I will be out of the money at expiration. But it's also a 74% chance, 74% chance that I will be out of the money at expiration. There's only a 36% chance that I will be in the money by 1 penny at expiration, right? But then when we're looking at selling just the call against it, then we are a 15 delta, which is a 15% probability that I will be in the money, or an 84% or 85% probability that I will be out of the money for the same amount. Yes, theoretically, this carries more risk because it's unlimited. But doesn't, if you're selling this close, feel like that carries more risk? To me, it does. Yeah, my risk is limited, but my probabilities are of success. This is what I was talking about. You go from the 36 to the 16, that's 20% difference on a total of 100% scale, right? It's even greater. It's it's over a 50% or 100% increase from 15 to 36. You can look at it that way also. It's almost like 100. What is that? It's almost 150% increase, really. So, in your risk, 20% difference going from what I was saying, 64% to 84%. So I would rather sell this naked one. Now, if you are in an IRA, which a lot of people do, then what I would suggest to do is you go in and you try, for one, if you're doing this as a naked call, I'd go in and sell it at 34 cents or offer it at 34 cents. Let it sit for a second, go back, cancel, replace, move it down to 33, and 33 or 32 is where I'm guessing you should be filled. All right. But if I were to look at this in an IRA and I'm like, okay, I got to have defined risk, but I want to have that synthetic naked short, then we're going to go out and buy the first strike we can pay a nickel for, which is probably that one. I mean, 6 cents offer, so I could probably get it maybe 4 cents or something like that. All right. And then I would try and sell this for, why is it locked? Did I sell the 23s? Yeah. So I'm going to jack this up because I don't know why it's giving me a bad price like that. Because if I sold, and I'm going to do the math on it, if I sold this at 34 and bought it for 5, yeah, I guess that's closer to 30. So I'd probably go in and offer it at 31 and then go down to 30 and then 29. And then I'm kind of going to walk away from that. Yes, you are going to have higher margin requirements for the naked call. Yes, you will. And, you know, this buying this for a nickel will help on the margin a little bit. One thing I want you to know is that if you set this up as a synthetic naked call like this, don't feel or don't get this wrong in your head that that is where your defined risk is. You're going to be out well before this. I want you to be out well before this. So if you did it as this type of strategy, if this increased in value threefold, so went to like 90 cents, that would, or somewhere between, yeah, like 90 cents, then that's where I would be getting out. All right. Does that make sense for everybody on that? I got a little ahead of us on this, but I want you to guys see why I like this as a naked call strategy. All right. So picking the right strikes, we are looking at a half standard deviation move on the spread. And then we're always all the way out to a 1 standard deviation move when we do the naked strategy. So this is the 1 standard deviation move that we're looking for. You add up all these percentage points going to the left and you come out very close to 16%. It's not showing all these other 0.1s over here, but it all adds up to being very close to 15 to 16%. And that means when we're selling this, think of this as the put side or this is the call side, either way. So we would be selling this 16 delta call, and then our probabilities of landing up in here are very slim. All of these probabilities added together to this side are our probabilities of success, in a sense, right? We have about an 84% probability of success when we add all these up. We only have a 16% probability of losing on this side, right? And one thing I was talking about with volatility, if you have really narrow volatility, this is a perfect bell curve. Our bell curves in options are skewed to the put side, to the call side. They're wanky. They sometimes will lean long like that and kind of do that, or they will go up tight like this and kind of have a long tail like that, okay? And this is still the middle. So it's called skew when you get that. Your 16 deltas are still going to be in the same locations, all right? That are your same probabilities, but it's going to be skewed a little bit. The 16 delta on a call might be closer than where the put 16 delta is in just equal distance from where the underlying is. And what I mean by that, so like if we were talking about 100, the underlying at 100 and the puts 16 delta could be like 94 and the 16 delta on the calls could be like 105. So $6 down or $5 up, right? So that's the skewness to the puts. This is a perfect bell curve to give you an example. And then when you get high volatility, what happens is the whole bell curve gets squished out really flat. And then you have your 16 deltas, which are way out here then. And then when it's really low, then the curve looks like this, right? And then your 16 deltas are like right there. So very close to where the underlying is in relation to where high volatility has the 16 deltas further away. Okay. Because remember, the delta is just telling you the probabilities. And when volatility is high, that means there's more movement or more probability of movement. Okay. So it's a 16 delta is a 16% probability, but now that it's moving all over the place, those 16 deltas are further away. Does that make sense? How do you protect from the underlying going down? The 30 cents may not offset the loss if the underlying goes down. Over time, it will. Over time, you're going to get it because we can see in the bonds, they have a tendency to settle down too, right? Even with TLT, we can go and look at it. So it's going to settle down. Yes, you could get stung on one of these like a year, which is a high probability, right? Or is a high likelihood, I should say, because you have a 15% probability. If you do this 100 times, you're going to get dinged 15 times. You're going to be right 85 times. All right. But it will happen every now and again. But over the course of time, if you stay mechanical and continue to do this every single month in a rising interest rate environment, then you will come out ahead over time. Does that make sense? So the 30 cents every month isn't going to offset necessarily that month's move. But if you continue to do this, there's going to be several months where it didn't affect you. And then when that move happens, then you're kind of already ahead of the game, right? Does that make sense, Tom? Since not tied to the bonds directly like a covered call, can this strategy be used as a substitute for bond portfolio? Yes, if you aren't accessing your bond portfolio necessarily, then this is a substitute for doing that directly in that portfolio. I think is that where you're going with that? Okay. I'm going to let you type and then I'm going to keep moving, but I'll try and come back if we get that. All right, so is everybody kind of clear on what the volatility does? Volatility squishes it, and when the volatility comes out, it shrivels up like a unblown up balloon. Okay. All right, so when do we get out of this thing? Well, that's something we always have to know, and we try to write this stuff down. Like, always keep track of all your stuff in a binder, you guys. Write down why you got into this strategy, what your assumption was, all of those things. Maybe the FOMC came out with the minutes and you saw some things in there too, or whatever. But write those things down so that when you go back in 10, 15 days, it gives you a little bit of refresher where you were and why you were thinking that. Also, write out when you are getting out of this. So I like to get out of it before that last 7 days to expiration. Especially if I'm starting to get close, I'm just going to take it off. You know, especially if when I'm saying start to get close, meaning my strike starts getting closer, maybe the bonds are starting to rally. I want to get out of that because the closer those bonds start rallying to my strike in that last 7 days, we have gamma adding into delta on those moves on the second dollar move, and that can really come back to haunt you quickly because gamma can rear its ugly head very quickly. So get out early and often. Now, if you're doing bonds, you can't really do this with TLT on, somewhere inside of, the 30% of profit. So like this is 10%. If you get 10% profit in one day on 30-cent TLT trade, it's the commissions and everything else aren't going to necessarily work. But if you're looking at bonds and you're doing this with the bonds, then absolutely, because the bonds are going to have lower commissions and they are paying out a lot more. So 10% reduction is a nice trade there. Then if you're doing just TLT, I would look at somewhere on, if you're at 30% after 3 days, I would seriously consider looking to cover it. You know, depending on how much you got, yeah, 10 cents is going to be close to not making money. But, you know, this is really where it starts being hard to not get out of it. 3 days and you're up 30%. I mean, you've crushed the odds at this point. You've crushed the odds. Anything under basically 40%, you're beating the odds. This is about right. 50% of max profit is going to take somewhere between 14 days. So what this means is, you know, if I'm over 10% after over 10% of max profit after 1 day, I'm covering over 20% after 2 days, I'm covering it. Idea, all right. Also, you know, or you could think of it, you reach 30% before 3 days and stuff like that. All right. Does that make sense? So if I'm at 50% of max profit in under 14 days, I'm covering it. I'm covering it anyway. The rest of these out here are kind of for your ballpark. If you guys like to try and squeeze out every last penny, then this is something I would seriously consider looking into if you're trying to go for that big payoff. Is, you know, 90% of max profit with 45 days being in that trade. I would seriously consider getting out of it. All right. Does that make sense? Whoa, I'm getting blown up here. I'm going to have to get my glasses out for this, I think. Give me a sec. Let me try and read a couple of these real quick so I can make sure everybody is clear concept. You're speaking about writing naked calls on TLT, but don't you hold the underlying or some other bond equivalent? Yes. Okay. So Dom, exactly. So TLT is an ETF, right? It's a basket of basically 20-year. So one thing we can't necessarily do is do apples to apples in a sense, where yes, our bonds are bonds, okay, and our TLT is a basket of bonds, which is a little bit different. So we can't get like, you know, doing Tesla covered calls. It just doesn't really work out that way. Even if we're doing /ZB, okay, which is the bond futures at the CME. We aren't going to be able to, if somebody tries to call away our bonds, then they aren't going to get that /ZB because we don't have it. We have real bonds that we can't really give them. All right. So you're going to have to get out of the trade for one. All right. You're going to take your loss. That's why I was take the loss, especially if you're doing that 15 delta. You know, when you're selling it at 30 cents, get out at like 90 cents. And if you have less risk, that's where I would be looking to do it. If you are, you know, less risk adverse, maybe you're going to go a little bit closer to, let's say, 70 or 80 cents, right? Okay. Did that answer your question, Don? So we can't do apples to apples, but we're trying to get as close as we can. And what we're doing by doing that is a bond future is basically equivalent to $100,000, and TLT is worth $10,000 or equivalent to $10,000. So we have to mix and match in a sense. So if you had $220,000 in bonds, then you would need to do 2 /ZB and 2 TLT, right? Because then that's 2 bonds, 2 TLT is worth 240. Does that make sense? All right. All right. Selling naked puts in an IRA perhaps more profitable than short strategies because less commissions on legs and from lowering a premium from the bought wings. Would you agree with this thought? I would not be selling naked puts. If we're talking about the bonds, then no. Right now, I would not be selling puts in bonds. No, because we are in a rising interest rate environment. And if I'm selling puts, that means the price goes down when interest rates go up. Oh, okay. Oh, as in a general question, William, I prefer selling naked calls and puts. It all depends on my directional assumption, right? So selling puts in a bullish environment in the equities, then absolutely, right now would be a good time to be doing that. If you have high implied volatility, though, William, if you haven't watched my naked calls and puts on just trading, watch that, because I have rules that go along with that that are really important to your success. Okay. All right. And then let me get through a couple of these because I want to go over the max profit of the loss of the spread as well. So our max profit is the credit received, no matter what. Anytime we're selling a short strategy, and this is the naked, we're going to get to keep that premium. Our max loss is unlimited. Remember, I talked about this and we just went over this, William. If we're short these calls in our margin account and our bonds are over there in the IRA, or not IRA, but 401k, then that bond can't get called away from us. We're just going to be short a bond future in our portfolio. We'd be short TLT or short the futures. Okay. So in a sense, it is unlimited because you're really not directly covering your bond portfolio. Right. And your break even is the short call strike, which is the covered aspect of it, plus that credit received. So if we sold the 100 call strike and collected $1, then our break even would be when the underlying is trading at 101. And that all is at expiration, basically, except for the unlimited loss. That's continuing as we go. All right. So if you're using this in an IRA, yes, IRAs, the people with the powers that be don't understand probabilities, and therefore they think naked strategies are scary. But our rules are we're going to be starting with that 35 delta, and I mentioned this. We're going to try and collect the third the width of the strikes, right? Like in the example I showed you earlier on TLT. Our max profit then is the net premium received, and obviously everybody has different commissions, but minus your commissions paid on any of this for the most part. And then our max loss is that short call strike, the width of the spread, basically short call strike minus the, long call strike minus the short call strike. I did it backwards because when I don't want you to get a negative number, right? So 105 minus 100, $5. So you go backwards just so you don't get a negative number. And then minus the premiums received plus the commissions paid. You got to add back in that commissions paid. All right. And then finally, break even is the short call strike plus the premium received is on the spreads. Okay, so now let's pull up the platform here and go through a couple of quick examples. It's going to be pretty easy because we don't have a whole lot of choices here. Now, you guys, one thing I know, now look, with TLT, it's a real bond ETF. There is another one out there, and it's TBT, and it is the double leveraged, negative leveraged ETF. So you can see as interest rates go up, this is going up also, and it is a bond portfolio, right? Or a bond ETF, I should say, 20 years. It's the same thing as TLT, but this is negative leveraged 2 times. So it is going to increase faster, and you guys can use this, but just know that then in this case, William, we would be selling puts, right? Because it's going to go up because it's a negative 2 times leveraged, and it's going to move faster than TLT. But, you know, if you're using that, know that you are not doing calls because this is a negative 1. Whereas TLT is normal. So I would usually use TLT and or the bonds, obviously. So we're going down in an increasing interest rate environment. You can see I have low implied volatility. It's not what I really want to be doing necessarily, but I got to stay mechanical with this. And the bottom line is I'm really not right now worried. Knock on wood. That was my head. No, actually it was my desk. But, you know, barring some black swan event, you know, I don't think the bonds are going to go up. Markets or the economic data coming out right now is pretty decent. It's not great. I'm not saying we're knocking it out of the park right now, but we are still moving along nicely. And we saw in the PMI numbers today that they're continuing to be above 50, and that's expansion in the economy. So that's all good, which would expect that the Fed isn't going to change their mandate. And that's all part of that environment, right? So we're moving down. It doesn't mean it can't pop, but we are looking for it to continue down. So in that, like I mentioned, if we're going to be doing that 35 delta, sell that, but you're buying the next one strike out, sold it for 33. Our risk is 79, right? Or sorry, 69. So 70%. All right. Then, but we do know we are only going to lose that, $700 at most. Whereas when we come out here to the 15 delta, then we know that we are out in the clear by a couple of strikes here even, right, for the same price. Yes, that in most people's eyes that write the laws say that this carries higher risk because it's unlimited to the upside. But we're in a rising interest rate environment. It's not going to turn around anytime soon. And if it does, you are going to start seeing that come up in the data points and the talking heads and stuff like that saying that the economy is slowing. That's when we don't want to necessarily be doing this strategy. If there is a possibility of them easing interest rates, all right? So selling calls against this. I would rather be here. Think about it. This 35 delta where we did that spread, my break even is going to be somewhere around 120.30, right? Because I collected that 30 cents. And then I'm out of my risk here once it trades up above 121. I'm at a max loss, but my 15 calls aren't even anywhere close yet still. I still got another $2 before I'm tested on that. So for me, that seems less risky. Yes, Banu, I'm sorry you were late. Yes, this is being recorded, so we will be sending this out. And if you guys ever don't get the recording, please reach out to us so we can make sure you get it, because I champion watching this again rather soon after watching this the first time. Even if you're watching it on tape delay, watch it again in the next day or two because it will make it sink in. Plus, the first time through, you got a lot of questions. This may be the way I'm teaching. This may be completely different than the way you've learned from somebody else. Okay. This is how I learned on the floor. So that's the way I'm going to teach it as well. I think it's better. And yeah, you can go online and figure out how to do some of these things, but they aren't going to give you strike locations. They're just going to say, selling out of money call. Go for it. But I'm trying to explain why I like the naked over the spread right here. Yeah, it seems like there's less risk in it, but to me, that the risk really is the probabilities of being in the money, and that's a lot more likely than this one out here. Does that make sense? Okay, so yeah, somebody's throwing out about the bonds. So if you do have a big bonds or a big portfolio of bonds, then you would be using the /ZB. And I would still go to that, 45 to 35 days is the best, but we don't have that option right now. So I'm going to start out here. Now, with these option prices, okay, a bond, there's 32 ticks for every full point. So this is 142, and it's really think of it as 0.13, okay? Now, when it gets to 31, that is basically one tick away from rolling over to 143. So as soon as that 32 hits, that makes this 143 even. Okay, so there's 32 ticks and a full point on a bond, right? And having said that, with 32 ticks and a full bond, it's worth a $1,000 bond. So each tick is 31.25, or it's a 32nd of $1,000 gives you 31.25. Well, these are in 64ths. So like the quote or comma, or not comma, what am I looking for? Anyway, the way this is written out, this 0.01, if you were to sell that, it would show up as a $15.625. So it's half of that 31.25 I talked about, the tick value of the value. There's 32 ticks in a point, but the value of each tick is 31.25. So that might be a little bit confusing. 32 ticks in a full point of a bond, but the value is 31.25. So half of 31.25 is 15.625. All right, on the option pricing. So that can be a little confusing. So if it's 21, basically you just multiply the 21 times the 15, and that's about what your credit is. So you kind of need to do that little bit of math when you're dealing with these, and it can get a little confusing. But if you just write down that these options are worth, each tick is worth $15.62.5, then you just multiply it. If it's 5, then it's 5 times that, okay? Thank you for your answers. How can I receive your step-by-step rules for naked puts, Eric? I'll talk about that here in a minute. Yeah, here in a minute, I'll do it. I got a deal for you, William. I got an offer for you for attending this. All right? So that's the basic strategy here, you guys. Take it off, especially with the bonds, you know, kind of follow that percentage of profitability on that, you know. With the bonds, TLT, you kind of got to go to 50% at least. If I'm collecting 33 cents, I'm probably getting out at around 15. Okay, that's my 50%. 50% plus a couple. All right. This one I would follow that little linear thing where the percent profitability and days in the trade kind of thing a little bit more closely here. Okay. Because you have that ability. They're giving that to you because they're giving you a big paycheck. All right. All right. And that's about it. Does anybody else have any other questions? I think I got everybody on that. All right. So, William, this is what I was talking about, and everybody else. This is in the chat window, this link. If you're watching this on tape delay, then you're going to have to pause it and type this into your URL. But this is, William, you asked at the right time, probably the best offer we have. And that's premium membership trial for 1 month for $7. All right. And that gets you guys absolutely everything. It gets you access to all of the videos. So, William, it's brilliant. You go in there, and instead of having these little dots, like if this was one of my webinars, after you get done watching it, you just click on it and it puts a check mark there. So you don't necessarily have to go straight down in order and remember exactly which ones you watched and which ones you haven't watched, right? So you can just check them off like that. I've watched that one twice or whatever, and I'm good to go. Also, you get the daily market commentaries. And I talk about in those daily market commentaries, you guys, every single trade I put on, when I take them off, and when they're going against me, which is, you know, anytime a trade goes against you, that's where your thought lies the most, right? So I talk about that the most because I'm trying to stay mechanical. I'm doing things to increase my probabilities in and around this trade that has gone awry. So I think that those are super important. A lot of you guys have given great feedback on those. So I think that those are showing up as value for you guys as well, a value add. So you get those daily market commentaries, and then you get online access to all those videos that I was talking about. Also, priority access to these. Sometimes we are filling up on these videos. You would get priority access on those. You also have unlimited access to me, you guys. And that's not on here, but that comes with the premium membership. The premium membership is if you guys have a trade on and it's not working out, you send me an email. I will respond to you ASAP, as fast as humanly possible. I know when a trade's going against me, I want some answers, especially back in the day when I was, you know, starting to trade. That I want to make sure you are clear of concept on, and reach out to me. I have a no inbox policy. I'm not going to leave you hanging. And believe it or not, I hate typing. So if I have to type a book to explain it, I would much rather just say, hey, let's jump on the phone and walk through this step by step so we don't miss anything. So unlimited access to me with the premium membership. All right. And basically, you guys have to be trading with this knowledge. I know you can learn how to do every single strategy out there known to man on Google, and you can get your option education by Google. But one thing I'm going to tell you is when you're getting your option education by Google, it's just how to do a strategy. It's sell, a short call spread is sell out of the money call and then sell or buy further out of the money call. You're on your way, be free. You've known what you need to know. No, you haven't learned what you needed to know. You need to know all these other little nuances about options so you can keep your powder dry. One thing one of my kids asked about, do I get nervous doing these webinars and going on TV and stuff like that? And I'm like, no. It was like, why? And I'm like, if you're prepared ahead of time and you've done everything you can in order to be prepared, then you aren't nervous. And, we also say it keeps your powder dry. You're not getting all sweaty. You're fine with it. You know your probabilities. You rely on that over time. You will see that these probabilities are working out. And when you start doing that, you're kind of like, all right, you know what? It's cool, man. Probabilities are beating me on this one. Next time I know it. Probabilities are my favorite. You just start rubbing your heads together. All right. But I want to thank you guys all. In later webinars, I'm going to be drilling down on different option components, when and where I find trades, how I trade and find them appropriate or whatever. Here's the link also. You're going to obviously have to pause it and type this in if you aren't there. Otherwise, I do have it in the chat window. We've been going back and forth on the questions window. There's another little one over there, little box that you might have to drop down to get to. It's the chat. And reach out to us with any questions, 310-598-6677, or you can email us at trading@protraderstrategies.com. All right. So yeah, the daily market commentaries are where I talk about all of my trades. Yes. And they are not trade recommendations, to keep in mind. I'm just talking about what I'm doing. It would be up to you guys to put that into your account appropriate for yourself. It's about time to type a book. Yes, Edward. Oh my God. I don't know. I couldn't do it. I'd have to have somebody type it for me. Thanks, superb webinar. Thanks, HH. Appreciate the kind words. Thanks, William. To avoid TLT going up on fear with a black swan event, would it be useful to trade with HYG? I have never traded HYG, so I would not be able to necessarily give a good recommendation on that right now. So if you've traded it a lot, then you could, I suppose, but I don't know very much about this. But I will drill into it, Patricia, now that you sparked my interest on it. Sure doesn't look like it has very good call options, but in that case, I'd probably stick with the TLT in this. Okay? I'd stick with TLT. What's the margin for selling a naked straddle? I wouldn't sell a naked straddle on this, Petro. I would stay away from that because I think bonds, the risk is to the downside right now. I don't see much risk to the upside right now. Okay. All right, so take advantage of that. Like I said, it's in the chat window. Literally, you guys, I mean, 1 full month, 5 days a week, with multiple daily market commentaries and webinars within that. That's a great deal. So take advantage of that for the all the stuff you get with that. You know, obviously, one thing you can do is increase the probabilities, but staying mechanical is probably even more important when something's going against you. So, and I talk about all that stuff in here. All right. So go ahead and click on that link, and that's about it for the day. Other than JQ, if you can't take that, take it easy. Take care, guys. Have a good afternoon, JQ.